Okay, everyone, welcome. Let's start with a bit of a riddle. How is it possible that a company with, say, $1 million in cash sitting in the bank could be teetering on the edge of bankruptcy? And on the flip side, how could another company with almost nothing in its checking account be in the middle of its most successful quarter ever? It sounds completely backwards, right? But it's not. The answer lies in one of the absolute cornerstones of business, the revenue recognition principle. And let me be clear, for those of you going into management, finance, marketing, whatever, this isn't just some dusty rule for accountants. This is the very foundation for how you will measure what's really going on in a business and make decisions that build a career.
So let's jump right into the big question. When you hear on the news that a company had record-breaking sales, what does that actually mean? I promise you, this is far from an academic exercise. The answer to this question determines whether an investment is brilliant or a total disaster. It can be the difference between getting a promotion or getting a pink slip. Understanding this is what separates the pros from the amateurs, and it all starts right here, by defining what a sale truly is.
You know, the most common intuitive answer is, well, it's a sale when you get the money. Makes sense, right? And for managing your own personal bank account, that's perfectly fine. But in the world of business, that assumption is a trap. It can lead to some absolutely terrible decisions. A management team that runs a multi-million-dollar company by just looking at the daily cash balance? That's like trying to fly a jumbo jet by just staring out the cockpit window. You're missing all the critical instruments telling you what's really happening. You're flying blind, and you won't know there's a problem until it's way, way too late. This slide really gets to the heart of it. Your company's financials tell two very different stories. Think of it this way. Cash received, that's just like your checking account. It's about liquidity. It answers the question, can we pay the bills and make payroll this month? And that's vital for sure. It's about survival. But revenue recognized? That's your report card. It's a measure of your performance. It answers the question, how much work did we actually do? How much value did we create this period? See the difference? A successful company needs both cash to survive and a great report card to show it's actually thriving. A smart manager knows how to read both.
Okay, so if we can't just count the cash, what do we do? How do we make sure that when we're looking at the financial reports for a behemoth like Apple and comparing them to a local startup, that we're actually comparing apples to apples? We need a standardized, reliable yardstick. And that's exactly why the accounting profession created a rule, a formal standard, to solve this very problem. It's called the revenue recognition principle. And here it is. I want everyone to really look at this definition. Revenue, that top-line number on your income statement that everyone gets so excited about, it gets recorded when two and only two conditions are met. And I want you to burn these two words into your brain: earned and realizable. Seriously, if you remember nothing else, remember these two words. Say it with me: earned and realizable. Let's dig into what this two-part test actually means. So it's a two-gate system. First, has the revenue been earned? This just means, did the company do what it promised to do? Was the card delivered? Was the consulting report finished and sent to the client? Is the work substantially done? If yes, you've passed through the first gate, but you're not done yet. Second, is it realizable? This means you have to be pretty darn sure you're actually going to get paid for that work. So an invoice to a stable, long-term customer like Coca-Cola, yeah, that's realizable. But a handshake deal with a brand new client who has a questionable credit history, maybe not so much. You have to pass through both gates to recognize revenue, not one, but both.
All right, theory is great, but let's make this real. This is where you really start to understand it. We're going to walk through a classic business scenario. I guarantee you'll see a version of this in your careers, and it's the perfect test case for our two conditions. Now, pay close attention to the wording here, completes a project. That means the work is done. The final presentation has been given, the report is on the client's desk, they've signed off. So I'm asking you, class, on January 31st, has our consulting firm earned the revenue? What do you think? Yes, 100%. They've delivered the value. They've held up their end of the bargain. So gate number one is officially passed.
Okay, on to the second gate. They send an invoice for a specific amount, $10,000. And for this example, let's assume the client is a big, reputable company with a perfect track record of paying its bills. So, is collection reasonably assured? Is it realizable? Absolutely. It's as close to a sure thing as you can get. Now notice the most important part of this whole story. Not one penny has changed hands. The company's bank account is exactly the same as it was yesterday. But as we'll see, for performance measurement, that doesn't matter one bit.
So here's the big question, the final exam for this little case study. We've gone through our two-part test. In which month does this firm get to book that 10 grand in revenue on its performance report? Is it January, when they did all the work?
Or do they have to wait until February when the cash actually shows up? Just think back to our two magic words, earned and realizable.
The answer, without a doubt, is January. And why? Because both of our conditions, earned and realizable, were met in January. The economic event happened in January. Think about it. To record that revenue in February would be fundamentally dishonest. It would make it look like the company did nothing in January and then got this magic $10,000 check in February. That's not what happened. This rule isn't just about bookkeeping. It's about telling the true story of a company's performance month by month, quarter by quarter.
And this takes us right back to that classic mistake so many people make. Imagine you're the manager of this consulting firm. It's January 31st. You look at your bank account and you don't see that $10,000. If you're only looking at cash, you might think, oh no, we had a terrible month. But that's just a snapshot. The income statement, on the other hand, is like the full movie of the month. It would correctly show $10,000 in revenue, painting the true picture of your successful performance. Your bank account tells you what you have, your income statement tells you what you've achieved.
Now, there's another piece to this puzzle. The revenue recognition principle works hand in hand with something called the matching principle. It's pretty simple. It says that you should record your expenses in the same period as the revenue they helped you earn. So, because we correctly recorded our $10,000 revenue in January, we can now match the salaries of the consultants who did the work in January against that revenue. This doesn't just show our sales, it gives us a true and fair view of our profitability for the month. And that's what really matters.
Okay, but you're probably thinking, Professor, the real world isn't always that neat and tidy. And you're right. Business loves to throw us curveballs. What happens if payment is super uncertain? Or what if you're providing a service that takes years to complete? Well, the great thing about this principle is that it has rules for those messy situations too.
Basically, if either of our two conditions, earned or realizable, gets shaky, the principle tells us to put on the brakes. Let's take uncertain delivery. Imagine a software company that installs a huge, complex system for a client. The contract says the client has 90 days to test it and formally accept it. Well, until that client signs on the dotted line, the job isn't truly done, so you have to wait to recognize the revenue. Or for complex payment terms, think about a gym membership. They can't recognize the full year's revenue on January 1st. Why? Because they have to earn it by providing the gym service each and every month. So they recognize that revenue bit by bit, month by month, as they deliver the service.
Now here's a huge, real-world example. A construction company gets a contract to build a massive bridge that's going to take 5 years and cost $1 billion. Are they really going to show zero revenue for 4 years and then $1 billion in year 5? Of course not. That would be absurd. Instead, they recognize revenue in stages, as they hit specific verifiable milestones. When the foundations are poured and inspected, that's a milestone. They can recognize a percentage of the revenue. When the first steel span is completed, that's another milestone. In this case, the earned condition is met step by step over the life of the project.
So let's put this all together. As a future business leader, this is what it all comes down to. The prudent, well-trained manager looks at their income statement and says, okay, our revenues are trending up by 8% quarter over quarter. It looks like market demand is strong. Let's analyze our expenses and see if we should invest more in marketing to accelerate this trend. It's calm, it's analytical. Now compare that to the flawed manager who looks at the bank account and shouts, hey, that big check from Acme Corp finally came in. We're rich. Let's go buy that new piece of equipment we wanted. See the problem? That second manager is making a huge investment based on a cash event that reflects work done months ago, and they might be completely ignoring that their actual performance this month was terrible. Please, do not be that manager.
So let's bring it right back to you and your careers. I don't care if you become an investor, a banker, a brand manager, or an entrepreneur. The language of your world will be financial statements. And understanding, truly, deeply understanding that the revenue line on an income statement is a measure of performance, not a measure of cash, is absolutely 100% non-negotiable. It's the key to making smart, defensible, data-driven decisions for the rest of your career.
So, if you only take a few things away from our talk today, let it be these. 1. Revenue is performance, not cash. 2. It has a strict two-part test, earned and realizable. 3. This system is what allows us to accurately compare companies and track their real progress. And 4, when you master this, you're not just learning an accounting rule. You are learning the fundamental language of business and value creation.
So I'll leave you with a final thought to chew on. The next time you see a big, flashy news headline about a company having a record-breaking sales quarter, I want you to stop. And before you get excited, I want you to think like an analyst. I want you to ask the hard questions. Questions like, okay, but did they have to offer huge discounts to pull sales from next quarter into this one? Or How much of that revenue is actually going to turn into cash? And most importantly, does their cash flow from operations tell the same good story? From now on, when you see a headline like that, will you just take it at face value, or will you dig deeper?